In this video, we'll be covering Alphabet and doing a full Google stock analysis. In my view, Alphabet is a top quality growth stock, one that you can buy, hold, and own in your portfolio for the long term, letting its growth compound for you over the years. The stock has provided very strong returns for shareholders in the past and appears to be in a position to continue doing so for new shareholders in the future. Now, in addition to covering the relative merits and risks of owning Google stock, we'll also walk through a simple valuation pricing to get the sense of when the stock is trading at a favorable price. If you're new here, take a second to subscribe to gain access to more investment content like this in the future. Alphabet is structured as a large holding company that contains many different companies, of which they're generally split into two parts. The first being the core Google products that most of us are familiar with as consumers, and then there's Other Bets, which contains companies focused on research and development and other long-term projects. Now we'll cover the more recent revenue numbers later, but Google still makes up the majority of their revenue from advertising, whether this is ads placed within Google Search, on YouTube, or across the internet. They also make money from their cloud platform, their Google Play App Store, as well as their hardware devices that they sell. We'll come back to the Other Bets in a bit. To get a sense of the scale just how dominant Google's position is in the internet, this infographic shows, scaled by size, the top 100 websites in the world by monthly visits. Google owns the top two, being Google and YouTube. The only other company that comes even remotely close is Facebook, but even combined with Instagram makes up less traffic than YouTube alone. In addition to that, of the top 100 websites, YouTube has by far the longest visit duration. So not only is YouTube the second largest website in the world, but people are also spending the most time there. This is a very valuable asset to Google and one that will only continue to grow in the future. Google isn't just dominant on the internet, but also in mobile as well. Since the introduction of the Android operating system for smartphones, Android quickly grew market share to become the dominant market leader. Android had 1.6% market share in the first quarter of 2009, and just 5 years later in 2014, they dominated the market, taking over 80% market share. While the market share growth has slowed down, they are still continuing to grow and now represent 88% of the OS market, where Apple's iOS makes up the remaining 12%. Now, while this ties back to the first infographic, when people are specifically searching for information online, Google has an even more dominant position. 94% of US browser-based searches go through a Google property. This provides a massive opportunity for Google not only to provide an advertisement, but to help collect data to make these advertisements more relevant and meaningful to you. Going back to the Other Bets section of Google, there's one company that is particularly interesting for a lot of investors, which is Waymo. It's their company focused on building software for autonomous vehicles. Now, when thinking about Waymo and where it will likely be 20 years from now in the future, I have a feeling it'll likely follow what I call the Google's DTM model. DTM standing for dominate, then monetize. If you look at Google's products with Google and YouTube and Android, Google's worked to first build a product to dominate market share, and then once they have that market share dominance, then focus on figuring out how to utilize that and monetize their properties. As an example, Google leverages their market dominance in Android through their Google Play Store. Every app that is sold through the Google Play Store, Google gets a cut of that revenue. When you consider that Google has over 85% market share in the smartphone market, that effectively captures a large majority of global app spending. If Waymo goes the way I think it will compared to other Google products, Google will focus on developing the best software there is possible and will likely provide that and make available to other auto manufacturers. This would allow Google to quickly dominate market share. With this market share dominance, they can get a lot of data. This data could be used to make this software more efficient and safer, further increasing their market share, as well as finding ways to potentially monetize this data or leverage their market dominance in this sector. Now, like Apple with their iOS, it's possible that in the autonomous driving market, you might have other competitors that decide not to use Waymo or Google's autonomous driving software and instead decide to use their own proprietary software. Tesla, for example, might decide to continue using their own software instead of opting to use Google's. This, however, I don't necessarily see as a large threat to Waymo long term, because if it follows the path of Android as effectively the operating system for cars and autonomous vehicles, it will likely become the market leader, and then you'll have a few auto manufacturers that decide to keep their own software in-house. Again, similar to what Apple does with iOS. From the financial side of things, Google looks to be in a position to continue their strong growth. In the last quarter, Google was growing revenues at a rate of 19% year over year, 22% if you adjust for currency fluctuations. These are strong growth rates for a scalable company, meaning because of its size and scale, a larger portion of these revenues end up becoming profits compared to a smaller company with relatively higher overhead expenses given its size. In addition, Google also has a record cash pile of over $120 billion. In an effort to try and allocate this cash more effectively, they've issued a $25 billion stock buyback, which for the first time in Google's history is actually leading to a declining share count. Should this trend continue as I expect it to, current shareholders will gradually own a larger percentage of the company even without purchasing any additional shares, as Google buys back shares themselves to reduce the total share count. Another thing that was encouraging in the recent earnings report was that paid clicks on Google properties were up 28% year over year compared to the second quarter in 2018. It's important, however, to mention that the cost per click, though, on those Google properties was actually down 11% over the same period in time. So effectively, Google was making slightly less per click, but drawing on a much larger base. Generally, I see this as a positive dynamic because while the pricing may change and fluctuate over time, having more paid clicks overall means that there are more advertisers using Google's services for advertising. Once an advertiser starts using Google's products, it's unlikely to leave that ecosystem. So while even in years where advertising pricing is a little more soft, potentially let's say during a recession, Google growing that advertiser base puts them in a strong position because once those prices rise back up with more advertising demand, that increasing cost per click is now applied on a much larger base of advertisers. This is why I'm not too concerned about the decrease in cost per click as long as we're seeing an increase in paid clicks, which implies an increase in advertisers. Another encouraging aspect of the earnings report was that within Google Other Revenues, which again is made up from Google Cloud, Google Play, and their hardware products, saw very strong growth, up 40% year over year. While advertising revenues and trends may vary year to year, the Google Cloud platform is effectively an enterprise-facing service or providing this service to other businesses. Because of the nature of this product, it will likely continue to see strong rates of growth regardless of changes in advertising spend. Overall, Google is a stock that I own and I feel very comfortable holding for the long term. Over time, internet traffic and usage is only going to increase, making Google's properties even more valuable. YouTube alone, for instance, is already in a market-dominating position, but it continues to grow at a rapid pace. If you think about changing trends in media consumption among generations, while prior generations grew up watching TV, younger generations are growing up watching YouTube. With these media habits ingrained early on, it's likely that future generations are going to be watching much more media content online through YouTube than compared to prior generations. This is a long-term secular tailwind that I think will greatly benefit the company. However, investing in Alphabet is not without its risks, one of the biggest ones being regulatory concerns. For instance, in 2018, Alphabet was hit with a $5.1 billion fine from the European Commission. Now, while this is likely a one-time expense, it's possible future fines could be levied or other regulatory actions taken at some point in the future that might affect Google and Alphabet's profitability. Unfortunately, there isn't a lot of merit in trying to predict regulatory changes simply because there's just so much uncertainty. As such, regulation risk is likely one that Alphabet shareholders will have to bear. In addition to that risk, Alphabet's core advertising products will be sensitive to a potential recession or economic downturn, when generally business advertising spend decreases. This likely would translate to a lower cost per click, which would decrease that core advertising revenue. During the last recession, from peak to bottom, Google stock saw a price decline of roughly 63% during that period, so investors do need to be aware that there is that risk. In addition, another general risk for growth stocks are stocks that generally trade at higher price to earnings ratios and other higher levels relative to fundamental metrics. It's these stocks that tend to see slightly greater declines than general market averages during market corrections or bear markets. This within itself is both a risk and an opportunity, because long-term investors might be able to take advantage of these temporarily depressed prices to buy shares at then more favorable valuations, which are likely to provide higher rates of expected return. For example, investors who bought Google shares at the beginning of 2009 have seen their investment return over 670%. Again, it helps having a long-term mindset and also having the cash and willingness to use that cash to invest in quality stocks at depressed prices. Valuation-wise, Google looks reasonably priced compared to current expected growth rates. This is a simple one-stage discounted dividend model to get an idea of what a fair price for Google stock would be under various scenarios. In this case, we're assuming Google can grow their earnings by 15% per year, which to be conservative is lower than their current 20% growth rate. Their current earnings per share is roughly $52, and the stock does not currently pay a dividend planned and isn't expected to in the future. For conservatism, while they are buying back shares, I'm going to assume that those shares bought back will be diluted by shares issued for stock compensation, making the total share count unchanged. If we assume the price to earnings ratio of Google in 10 years will be 20 and our required annual rate of return is 15%, then the price to buy the stock at would be roughly $1,040. Google's stock actually hit this price in early June as a market overreaction to antitrust concerns. I actually initiated a small position myself in Google stock here and expect that capital to likely appreciate at double-digit rates of return over the next 5 to 10 years. If you're willing to accept lower rates of return, let's say instead of 15% you accept 12%, then the stock appears to be trading at a discount to its fair valuation, assuming those 15% earnings growth rates turn out to be true. Assuming the assumptions in the model play out, the price required to get a 12% annual rate of return is roughly $1,350 per share. Given the current price of roughly $1,230 per share, this represents roughly a 10% margin of safety, or the current price is 10% below what you consider a fair valuation for the stock. In this sense, even though Google is a growth stock trading at a price to earnings multiple above the market average, it could still potentially be a good value and of interest to value investors who believe the stock is trading at a fair price relative to its expected growth rates. Overall, this is a stock I own and plan to add to my position over time and plan to hold for the very long term. Overall, I hope you got some value out of this video, and I'm curious to hear your thoughts on Google stock. Is this a stock you own or would consider owning at some point in the future? And if so, at what price? Again, thank you for watching. My name's Michael, and I will see you in the next video.